Imagine you're in a meeting discussing multiple alternatives for an important business decision. Each option has its advocates, and the conversation starts shifting toward personal opinions. Some prefer one alternative because it feels right, while others defer to the most senior person in the room. But then someone asks, "What's the ROI?" And suddenly, the conversation changes. Instead of debating opinions, everyone's now aligned on the data. The decision's no longer about personal preference, it's about which alternative delivers the greatest value. This is why economic analysis is critical. Without it, decisions become subjective, influenced by personal biases or the most persuasive voice in the room. By objectively quantifying the value of each alternative, we ensure that the team makes the best decision for the business, not just the most popular one. And in this step of the decision-making framework, we're going to show you exactly how to do that. But first, a quick disclaimer. Doing economic analysis can be pretty complicated. People get accounting and finance degrees to do this stuff. We can't cover all the things you need to be an expert at economic analysis in this lesson. However, what we can do is show you how to use a structured model that simplifies this for you. Better yet, we'll provide you one that you can use. And if you want to learn more about some of the accounting and financial principles we'll discuss in this lesson, make sure you check out our course on economic analysis. It will give you a solid foundation of the principles you need to understand to make good financial decisions, without having to get an accounting or finance degree. Here are the objectives of Step 5 of Enabling Empowerment's decision-making framework, Perform Economic Analysis. 1. Eliminate subjectivity. Without economic analysis, decisions are based on opinions, politics, or gut instinct. By quantifying the value of each alternative, we ensure decisions are made based on facts, not personal influence. 2. Enable apples-to-apples comparisons. A structured financial analysis ensures all alternatives are evaluated using the same criteria, allowing us to compare them objectively. 3. Look beyond just ROI. While ROI is important, we also need to consider other key financial metrics like cash flow, payback period, and total investment required. These factors ensure we make a well-rounded decision. Here are some common pitfalls people make when performing economic analysis and how to avoid them. 1. Forcing the analysis to show a desired outcome. One of the biggest mistakes people make is adjusting the numbers to justify a preferred alternative instead of using the analysis to gain true insight. This can lead to overconfidence in a bad decision or rejecting a superior option. Instead of using the financial model as a flashlight to illuminate the best path, they use it as a hammer to force an answer. The solution? Treat the analysis as a tool to understand reality, not justify a preference. If the numbers don't support an alternative, that's a signal to rethink it, not manipulate the data. 2. Not using good principles of financial and economic analysis. Many decision makers either don't have a financial model or use one that doesn't follow sound economic principles. They may ignore opportunity costs, fail to consider uncertainty, or use a simplistic payback calculation that ignores long-term value. The solution? We encourage you to use a structured financial model that has good financial and economic analysis principles embedded in it. Let's face it, most of us don't have an accounting or finance degree, so we don't have the time or expertise to create a model from scratch to analyze every alternative. Hopefully your company's accounting department has developed one that you can use. If not, in this lesson, we'll provide you a copy of Enabling Empowerment's Capital Project Financial Model and briefly demonstrate how to use it. 3. Only comparing ROI without context. A project might have a strong ROI, but what if the payback period's too long? Or what if the financial upside depends on unrealistic assumptions? Without considering context, a misleading ROI can push teams toward a bad decision. The solution? Go beyond just ROI. Look at payback period, cash flow, and other metrics that give us a comprehensive view of the range of outcomes. Now, let's discuss how to perform economic analysis the right way. Here's a step-by-step process we follow in Step 5 of Enabling Empowerment's decision-making framework. Step 1. Start with your key drivers. Pull the ranges you estimated in Step 4 for your key variables. Things like the production increase, the cost savings, or the capital investment. Step 2. Use a financial model to calculate ROI. We'll use Enabling Empowerment's financial model for capital projects to calculate ROI, net present value, and payback period across different scenarios. Step 3. Evaluate the range of outcomes. Instead of just looking at a single expected ROI, we evaluate the best case, what happens if everything goes perfectly, the most likely case, what's the expected outcome based on realistic assumptions, and the worst case, what happens if things go wrong. This is one of the advantages of using Enabling Empowerment's financial model. Most models only allow you to input a single point estimate for most variables. So if you want to evaluate the best case, worst case, and expected case, you'll have to run the model 3 different times. Our model, however, lets you input ranges for estimates, so it shows a comparison of the best case, worst case, and expected case side by side. And you only have to run the model once. We'll show you how that works in the case study. Step 4, compare against alternatives. Finally, we need to use our financial model to evaluate each of the alternatives we are still considering so that we can compare them side by side and objectively determine which is the best course of action. Let's return to our Widget Turner 5000 case study. In step 4, we estimated the ranges for our key drivers and the other variables that we need to analyze. Here are those as a reminder. Now, we simply plug those numbers into our financial model. We'll be using Enabling Empowerment's financial model for capital projects to demonstrate how to do that. Check the lesson notes for a link to download the model and a more detailed lesson on how to set it up and use it. For the purposes of this course, we'll give you a quick tour. The first thing you will need to do is make sure that the model is set up correctly. This includes checking that the depreciation tables, the tax rate, and the discount rate are correct. These are things that your accounting department can verify for you. Or again, if you want to know how to determine these for yourself, check out our economic analysis course. Next, we'll enter the start date, the date we will start spending money, the startup date, the date we'll start receiving benefits, and the project life, how long we'll receive those benefits. Now we're ready to enter the cost of the equipment. We'll do that here in the project expenditures section. Next, we'll enter the data from the key drivers into the economic value drivers section. We can enter this data as a one-time cost or as a recurring variable or fixed cost. The other benefit of this model is that we can also enter our upside and downsides right into this model. We do that here. This model has some options for adjusting recurring costs or benefits from year to year based on things like inflation, changes in contracts, etc. We won't mess with any of that for now. Your company's model may or may not have that. And again, if you want to understand more about that, check out our in-depth courses on how to use our financial model or our course on economic analysis. Now that we've entered the data, we can check out the results. If we go to the Summary tab, we can see the key metrics for the upside, downside, and expected cases for installing the Widget Turner 5000. As you can see, this project has an expected return of 23.9% with a net present value of $603,000 and a payback period of less than 4 years. That's pretty good. However, we also notice that the downside case only has a return of 3.3% and a net present value of negative $173,000. That means we should probably spend some more time studying our assumptions for the downside case and making sure that we have a good plan of action to prevent that from occurring. While we're here, if you remember back from the lesson on step 3, identify key drivers, we talked about doing sensitivity analysis, and we mentioned that the financial model that we provide can help you do that. Here's what that looks like. As you can see, this model has taken each of the drivers that we entered data for and automatically created a sensitivity graph that shows how a 1% change in the variable impacts the rate of return and the net present value of the project. The steeper the curve, the more sensitive the outcome of the decision is to that driver. For instance, in this example, the curve for production margin is much steeper than the curve for electrical cost. That tells us that we should spend a lot more time and energy making sure we have the production margin correct and not nearly as much on the electrical cost. Finally, we now need to perform the economic analysis for the other alternatives we're considering so we can compare them. If you remember, those other alternatives were adding a fourth operator and installing a Widget Turner 7000. I've already done that for us. Now we can compare the output of the model for each of the alternatives. Here's what that looks like. As you can see, the option to add a fourth operator doesn't require any additional capital spend, but is only expected to have a net present value of $218,000. Versus a Widget Turner 5000's expected net present value of $603,000. This is why looking at all the financial metrics for a decision is important. If Awesome Widgets is tight on cash, we might want to go ahead and add the fourth operator, even though we will likely make less money than we will in the long run if we install the Widget Turner 5000. That would allow us to save the $1 million we have and invest it in something else. It also has lower risk since it is projected to make money in the downside case, while the Widget Turner 5000 is projected to lose money. Looking at the Widget Turner 7000, that option is clearly not as good as the other two, since even in the expected case it loses money. For the purposes of the remainder of this case, we will assume Awesome Widgets has plenty of capital and has decided it is willing to take on that risk to get the much higher returns from that investment. Look, That was a lot of information, very fast, and probably a bit overwhelming. As a reminder, if you want a more in-depth demonstration of how to use our financial model, check the link in the notes below. If your company has developed its own financial model, someone in your accounting department should be able to help you use it. And if you have lots of questions about what NPV, IRR, and a lot of other financial terms mean, check out our course on economic analysis. Finally, if you want even more help, once you've completed this course, you will receive an offer for one-on-one training where we will help you take an opportunity or problem that you want to make a decision about, or you want to make a recommendation to your leadership team about, and we'll help you take that decision through the decision-making framework, including entering your data into the financial model. The key takeaway here is that performing economic analysis is a critical step in making decisions, not just to calculate numbers, but to drive alignment and ensure decisions are made based on objective data rather than personal opinions. By following this process, we move beyond debating preferences and make decisions based on financial impact and strategic fit. In step 6, we'll take our chosen alternatives and determine what capabilities and resources are needed to make it a reality.